Holdings and L&T Finance Holdings. Let me welcome on board the newly appointed MD and CEO, Sudipta Roy, joining in on the show right now. Sudipta, hi, morning. Good to have you on ET now. Your retail growth for the quarter came in higher than, the target that you had set out. That's your Lakshya 2026 target, right? For the third consecutive quarter. Which segments are particularly contributing, and is this the sustainable figure going ahead?
All of the segments actually are growing satisfactorily. It's not that one single segment is outgrowing any other segment. And if you would know that our main lines of business are our rural business finance vertical, our urban finance vertical, as well as our farmer finance vertical. So each of these verticals have been growing satisfactorily over the past couple of quarters. And as you know, in this particular quarter, there is the added benefit of having a festive period, wherein certain urban products like two-wheelers or tractors have a natural tendency for customer purchase. So basis that, all our businesses have done reasonably satisfactorily growth, and we are sort of hopeful of continuing this great growth trajectory going forward.
But going into Q4, which is generally a strong quarter for lenders, do you expect to sustain this kind of momentum? And is it fair to, assume that you will end the year with a retail growth of over 30% at least?
As far as our Lakshya target guidelines, we have guided that we will grow at around 25%. So we remain committed to that particular guidance that we have given in our Lakshya targets. As of now, I would not like to give sort of any specific number guidance for Q4, but we expect that we will continue on our trajectory that we have guided in our Lakshya targets of 25% odd.
Right. Mr. Roy, morning. Could you provide any sort of a timeline in terms of the rundown of the wholesale book? When can the overall loan book start posting strong growth?
So as you know that we have been sort of running down our wholesale book and paring down our wholesale book, and currently our wholesale book stands at about 7,000 crores, which is a degrowth of about 1,300 crores from what was there in Q2FY24. And so we remain sort of committed on reducing our wholesale book, but obviously maybe the speed at which the sort of the degrowth has happened over the last couple of quarters, there might be some tempering in that, because currently the most of the assets that we have in our current wholesale book are scattered assets. And on the other side, we are also working on increasing our retail disbursements as well as our retail book. You would have noticed from the overall numbers that our retail book has added in terms of book size this quarter compared to the previous quarter. And that growth, as we keep on sharpening our retail disbursement engine and our execution engines, that growth will keep on sharpening. So you will see the book growing reasonably strongly hereafter. And we are committed on sort of paring down our wholesale book and transforming to a largely, a retail financial services company. And that sort of transition will take the next couple of quarters to complete.
Right, and your NII as well is higher than what the street was anticipating, right? Help us understand what's played out here, whether there was any repricing of yields, and how have you managed to, how have you managed your cost of borrowings?
See, our sort of the composition of our products, if you see overall, in the previous quarters, we have been degrowing our wholesale book, and we have been moving more and more retail. Right now, if you see, as far as we have given our guidance, we're almost 91% retail book size now. So obviously, wholesale has lower yields and retail obviously has much higher yields. And if you look at the composition of portfolio, the rural business finance portfolio has normally is a high yield business. The two-wheeler business is also normally a high yield business. So given the composition of the rural products, which are naturally in high yield, we have been able to maintain our NIMs, and we expect that we should be able to. And if you look at our cost of funds, and which we have given in our analyst presentation also, our cost of funds has remained relatively stable, has moved by only 2 basis points compared to last quarter. So that's how we have been able to maintain more or less steady state NIMs.
Sure, but given the fact that banks are rationing credit a bit, any specific impact you foresee on the cost of borrowings for yourself in the near term? And going ahead, beyond let's say 2-3 quarters, when the rate cycle does turn, how's the cost of fund trajectory expected to move for you?
So, as we are all aware that RBI has been sort of nudging the entire retail financial industry to be cautious on the consumer credit side, and obviously has increased the RWAs on part of the unsecured credit. So we have sort of calculated what might be the impact on our cost of borrowing going forward, and we have our guidance is that we'll probably see probably a 10 to 12 basis point increase in our cost of borrowing, everything remaining, other things remaining constant over the next 1 year period. So in terms of the impact, yes, there is some impact, but I do not consider a 10 to 12 basis point impact very significant. And as and when the rate cycle sort of starts adjusting again, maybe that might give us some breathing space in the entire sort of cost of borrowing space. So going forward, we expect that at least for the next 2 to 3 quarters, maybe the cost of borrowing sort of remain within uh, from our current, go up max about 10 to 12 basis points from what our current cost of borrowings are. And depending upon whatever RBI's rate cycle starts happening, that's a discussion at that particular point in time.
Right, and you have also taken over from the reins of Mr. Dubhashi. What are some of the targets that you have set for yourself, or how would the company really evolve under your leadership?
So as you see, we are transitioning to a completely transitioning to a retail finance company, and what we call define at fintech at scale, and NBFC, which in sort of underpinning that we define as fintech at scale. So as part of that, and we have sort of set ourselves an ambitious goal of sort of transformation while following the Lakshya goals on what we call 5 pillars of execution. Firstly, obviously, increase the customer acquisition velocity that we have. So over quarter on quarter, we'll try to put more new customers into the fold. The second thing that we will try to do is sort of improve our credit metrics or improve our credit quality, our quality of credit delivery is what we will try to do. And for that, we are building a new advanced credit engine that not only ingests the bureau data, but also looks at account aggregate data and also looks at sort of what we call orthogonal signals or lifestyle or sort of trade signals available in the market. So we are also working on sort of building a futuristic digital architecture. We are working on sort of improving the customer journeys, especially on all our digital platforms, and making sure that the underlying technology is far more improved to take in the increased flow of customer acquisition. On a fourth pillar is what we are looking at increasing our brand visibility. We have sort of hired a new chief marketing officer, and you will be seeing us present in the market in terms of brand visibility over the next couple of quarters in a significant way. And last but not the least, we are investing in our capability building in the technology area, in the trade and risk area, as well as in the data analytics and
Sure. So, given the completion of the merger with subsidiaries, your move towards realization, your Lakshya 2026 targets, how differently would your ROA and ROE look for the couple of years down the line?
So, we have guided on ROAs. We have our guidance on ROA as per our Lakshya strategy is 2.8 to 3%. And now, post our merger, wherein we have merged L&T Finance and LTICL, L&T Infrastructure Credit Limited with LTFH, and now it is one single entity. Our guidance had been that, we will move into a 2.8% to 3% ROA trajectory. So we expect that we will continue on the trajectory. Currently, we are at about 2.53% consolidated ROA, and ROA improvement trajectory will continue. So, we expect that around exit FY26, we should be somewhere near the 3% ROA levels. So, that is what we would guide. On the ROE side, obviously, we would like to move towards as an organization, will move towards a 15% ROE. So we are hoping that during that course of time around FY26, when we sort of hit the 3% ROA level, we would be more or less near that number as well.
Okay, so a good set number coming in from L&T Finance, and that's the management talking about the outlook going forward. Thanks so much for making time and speaking with us. Quickly taking stock of a few buzzers, IFCI is up around 16.